Not all income is taxed the same. Understanding the differences can save you thousands and help you build real wealth. Two people can make $100,000 this year. One pays $37,000 in taxes, the other pays zero. Same income, completely different tax bill. The difference? It's not a loophole. It's not a cheat. It's the type of income they earn. And most people have no idea this distinction even exists. In the next few minutes, I'm going to show you exactly how this works and what it means for your future. Here's what we'll be covering today. Earned income is the income most people live on, and it's taxed the hardest. Number two, we have investment income, where the tax code starts to work in your favor if you know the rules. And then, of course, we have passive income. That's rental properties, partnerships, and another category with its own rules that most people ignore. Hi, my name is Tommy Cloud. I'm president of Third Act Retirement Planning, a company that I started back in 2000. I'm also a certified financial planner and qualified Kingdom advisor. Here at Third Act Retirement, we believe money should bring clarity and peace, not confusion and fear. Our why is to walk with people who've suddenly come into wealth, helping them move from overwhelm to confidence so they can make calm, informed decisions about their future and legacy. Let's break it down. Let's start with earned income. Earned income is the money you work for every day. Your salary, hourly wage, tips, bonuses, commissions. If you show up and do the work, this is earned income. Here's the hard truth. The IRS hits earned income the hardest. It's taxed at ordinary income rates, progressive brackets from 10 all the way up to 37%. But it doesn't stop there. You also pay payroll taxes, 6.2% for Social Security. You pay 1.45% for Medicare, with your employer matching both. High earners pay an extra 0.9% for Medicare. If you're self-employed, you pay both sides, over 15% in payroll taxes before income tax even starts. And that amount goes all the way up to an income that really only the top 20% even make. So most everyone is paying these Social Security and Medicare taxes. Earned income is important. It funds your life. But from a tax standpoint, it's the most expensive income you have. And that's where we get into investment income, where the tax code rewards patience. Now let's talk about investment income, where the rules change dramatically. Investment income comes in a few flavors: interest, dividends, and capital gains. Interest income is taxed just earned income, ordinary rates. Interest income from savings bonds, savings accounts, CDs, and then dividends. If you hold a stock long enough, you get qualified dividends, taxed at 0%, 15%, or 20%, depending on your income. The vast majority of people will fall into that 15% bracket on dividends. And yes, you can get taxed at 0% if your other income is low enough. What about capital gains? A stock in under a year, that's a short-term gain, taxed at your ordinary rate. And by the way, on dividends, you need to hold for 60 days in order to have qualified dividends. But back to capital gains, it is a year. And anything less than a year is a short-term gain. And that's going to be taxed at your ordinary rate. If you hold it for more than a year, it goes back to the same qualified dividend rate. And that's a long-term capital gain is what we call that. And it'll be taxed at 0, 15, or even 20%. And this chart you can see here shows you that. The 37% that's taxed on the ordinary income, and then the lower taxes are over here, down here at the bottom, and what it takes to get there. So keep that in mind as you're thinking about your taxes. The takeaway is patience pays. Holding investments longer than a year can dramatically cut your tax bill. And then what we do is we get into passive income, and these are the rules that most people miss. The third category is passive income. This is money from activities you don't actively work in, like rental properties or being a limited partner in a business. Passive income is taxed at ordinary rates, just like your paycheck. No special discount. But here's the rule. The IRS says passive losses. If your rental property loses money, you cannot just deduct the loss against your salary. The IRS says passive losses can only offset passive income, not your W-2 wages. If you have multiple rentals, A loss from one can offset profits from another. But for most people, passive losses stay in their own lane. Knowing this rule prevents costly surprises at tax time. So here's the big picture. Earned income is taxed the hardest, up to 37%, plus those payroll taxes. Investment income, especially long-term gains and qualified dividends, can be taxed as low as 0% if you're strategic, although most people will fall into the 15% bracket based on their income. Passive income follows its own set of rules that most people simply don't know. People who build real wealth don't just earn more, they understand which type of income they're earning and they plan around it. If this makes you think about how income tax fits into your bigger retirement picture or bigger financial picture, do one of two things. Option one, take our free How Much Money Do I Need to Retire quiz. The link is right below this video. It takes about 2 minutes and gives you a personalized starting point. Option two, you can apply for a free tax planning session with our team. We'll look at your full 2025 income picture, earned, investment, and passive, and we'll help you build a strategy for 2026 that keeps more money where it belongs, and that's with you. Either way, take action today. Action wins. Mere talk brings about poverty. Tax code rewards those who plan and act. Don't leave that money on the table, and I'll see you in the next video.